The fifth learning objective is to use the time value of money, the present value of a bond, and effective interest amortization, which is Appendix 11A. The term time value of money refers to the fact that money earns interest over time. Interest is the cost of using money. To borrowers, interest is the expense of using somebody else's money. To lenders, interest is the revenue earned from lending. Often, a person knows a future amount, such as the maturity value of a bond, and needs to know the bond's present value. The present value of the bond measures its price and tells an investor how much to pay for the bond today. An investment promises you $5,000 at the end of 1 year. How much money you pay now to acquire this investment? You would be willing to pay the present value of the $5,000 future amount. Present value depends on 3 factors. The amount will be received in the future, the time span between your investment and your future receipt, and the interest rate. Computing a present value is called discounting because the present value is always less than the future value. In our example, the future receipt is $5,000. The investment period is 1 year. Assume that you require an annual interest rate of 10% on your investment. You can compute present value of $5,000 at 10% for 1 year as follows. The future value divided by 1 plus the interest rate, so the present value of $5,000 to be received 1 year from now is $4,545. If the $5,000 is to be received 2 years from now, the present value of the $5,000 to be received 2 years from now is $4,132. We have shown how to compute a present value, but that computation is burdensome for an investment that spans many years. Present value tables ease our work. Annuity investments provide multiple receipts of an equal amount at equal time intervals. Present value of $1 table from Appendix B, Table B1. One way to ease the computational burden is to add the 3 present values of $1, that's 0.893 plus 0.797 plus 0.712, and multiply their sum, which is 2.402, by the annual cash receipt, $10,000, to obtain the present value of the annuity. $10,000 times 2.402 equals $24,020. An easier approach is to use a present value of an annuity table. Appendix B, Table B2, shows the present value of an annuity of $1 to be received at the end of each period for a given number of periods. The present value of a bond, its market price, is the sum of the present value of the principal amount to be received at maturity, a single amount, present value of $1, plus the present value of the future stated interest amounts, an annuity because it occurs in equal amounts over equal time periods. Remember, the present value of a bond, its market price, is the sum of the present value of the principal amount to be received at maturity plus the present value of the future stated interest amounts. We began this chapter with straight line amortization to introduce the concept of amortizing bonds. A more precise way of amortizing bonds is used in practice, and it is called the effective interest method. This appendix explains the present value concepts used to amortize bond discounts and premiums using the effective interest model. Generally accepted accounting principles require that interest expense be measured using an effective interest method unless the straight line amounts are similar. In that case, either method is permitted. Total interest expense over the life of the bonds is the same under both methods. However, interest expense each year is different between the two methods. The accounts debited or credited under the effective interest method and the straight line method are the same, only amounts differ. An amortization table shows the gradual write-off of the discount to interest expense over the life of the bond. The interest payment is equal to the stated rate of interest times the maturity value of the bonds. The interest expense is equal to the market rate of interest times the carrying value of the bonds. The difference between the two is the amount of discount to be written off to interest. This adjustment decreases the discount amount and increases the carrying value of the bonds. This continues to the end of the bond's life, at which time the carrying value will equal the maturity value of the bonds. The journal entry for the issuance of the bonds remains unchanged for the effective interest amortization of bond discount. Interest expense is debited for the market rate of interest times the carrying value of the bonds. Cash is credited for the stated rate of interest times the bond's maturity value. The difference between the interest expense and cash payment, $4,807 minus $4,500, is the portion of the discount on bonds being amortized for this period, which is $307. An amortization table shows the gradual write-off of the premium to interest expense over the life of the bonds. The interest payment is equal to the stated rate of the interest times the maturity value of the bonds. The interest expense is equal to the market rate of interest times the carrying value of the bonds. The difference between the two is the amount of premium to be written off to interest. This adjustment increases the premium amount and decreases the carrying value of the bond. This continues to the end of the bond's life, at which time the carrying value will equal the maturity value of the bond. The journal entry for the issuance of the bonds remain unchanged for the effective interest amortization of bond premium. Interest expense is debited for the market rate of interest times the carrying value of the bonds. Cash is credited for the stated rate of interest times the bond's maturity value. The difference between the cash payment and interest expense, $4,500 minus $4,164, is the portion of the premium on bonds being amortized for this period, which is $336. Interest rates determine the present value of future amounts. Determine the present value of a 7-year bonds payable with maturity value of $91,000 and stated interest rate of 14% paid semi-annually. The market rate of interest is 14% at issuance. The same bonds payable, but the market rate is 16%, and the same bond payable, but the market rate is 12%. So the market rate, in example number 1, the $91,000, the present value of this bond is $91,000. Same bond, but the market interest rate is 16%, and the same bond, but the interest rate is 12%.